Hello everyone. Let us see what is share market and some of its aspects. Share market is a market where shares of a company are bought and sold. Share is nothing but a company's capital divided into small units. So, they register in the stock exchange in order to sell their shares to raise their capital and expand their business. For registration, a company should get approval from Security Exchange Board of India. After the registration, the company will be listed either in NSE or in BSE or in both, which are the two types of share market. National Stock Exchange of India is the leading stock exchange which is owned by various global financial institutions, public and private owned entities. It is located in Wall Street of Mumbai and holds 1600 companies. Bombay Stock Exchange holds nearly 6,000 companies and it is the first stock exchange of Asia. It is located in Dalal Street of Mumbai and it also includes service of equity trading platform for small and medium enterprises. It also provides other services like clearing, settlement and risk management for companies. The fluctuations of the market, that is, the company's fall and rise of share price of both the market, is disclosed in a single term called index. Index is the total market position. Index of NSE is called Nifty and index of BSE is called Sensex. Every day, trader or investor is looking out for one or the other opportunity or different criteria to find their best bet. This is when indices such as Nifty 50 or Sensex comes into the picture, as they play a crucial role in defining the flow of stock in a certain direction. They are considered as barometers of stock market. People could view the index of both the market through following official websites. Steps to purchase a share. For purchasing a share, first one must attain an online broker by providing certain account details. Next, conducting research on company and market. Then, to decide in what price the share has to be bought. And then, purchase the share will be shown in the portfolio. Things required to purchase or sell a share is a bank account, trading account and a demat account. Let us see how it works. Here, trading account acts as a medium for purchase and sale of a share. The purchased share will be stored in demat account and paid through bank account. For sale, share will be transferred from demat account to stock market and amount will be credited in bank account. Let's see how Alfred Marshall's law of demand and supply plays in share market. When the supply of share decrease and demand increase, the price will increase. When the supply of share increase and demand decrease, the price will decrease. This happens because whenever the demand increases for a share, the price of the share will rise and people will sell it in order to gain profit. Whenever the price falls, supply expands and people buy it in order to sell it in higher price in future. So, demand and price are proportionate to each other. According to the rise and fall in price, the market fluctuates. There are two types of fluctuations, that is, bull and bear market. Bull market is a condition where share prices are rising or expected to rise, like a bull thrush its horns up into the air. If the trend was downwards, then it is bear market. The share price falls or expected to fall. Bull versus bear. Bull represents optimism and bear represents pessimism. In bull market, there will be 20% rise after two falls and economic expansion. In bear market, there will be 20% fall from recent highs and economic contraction. The average rise period of a bull market is 1 to 7 years and the average fall period of a bear market is 1 year. There are four types of trading, that is scalping, swing trading, intraday trading and positioning. Scalping is a trade where person buys and sells share within 5 to 10 minutes, and swing trading is a trade where share is bought and sold within 1 to 4 weeks. Intraday is a trade where share is bought and sold within a day between 9:15 a.m. to 3:30 p.m. Positioning means holding the stock for 4 weeks to 1 year. One who trades is called a trader, and in share market there is another set of people called investors. There is a huge difference between an investor and a trader. An investor is one who seeks large return over extended period through buying and holding the shares, where traders take advantage of both rising and falling of markets to enter and exit the positions over a shorter time frame, taking smaller, more frequent profits. Let us see the most popular and successful investor and a trader. Warren Buffett is one of the most successful investors ever lived, whose net worth is $16 billion. He owns Berkshire Hathaway, a conglomerate worth $496 billion. He sticks to the style of value investing and lives in a frugal lifestyle. George Soros, whose net worth is $8.3 billion, known as the man who broke the Bank of England by shorting the pound sterling. He is a short-term speculator and has a contrarian mindset. He applied the theory of reflexivity into the market, which became his crowning jewel. To attain success, a person can be an investor or a trader, but he should analyze the market fluctuations and wait patiently for the right time to purchase or sell a share in a beneficial way. Patience is the key element of success. Thank you.